So, hello, ladies and gentlemen. I hope you've been enjoying the greatest show on earth, and that show is the U.S. stock market for the past couple of weeks. Good Lord, we've gone insane. This is the market recap for week of January 25th, and I'm going to spend the whole thing talking about GameStop because that's definitely the biggest news that's been going on. So our main attraction has been GameStop roaring from a high of $160 on Monday to a high of over $450 on Thursday. So let me outline what's going on for those of you who might not know. So there's this thing on Wall Street in stocks called short selling. Now, chances are you're not the person that will be doing short selling because that's generally done by larger institutions, but I'll be using the second person because it's just easier for me to say. So let's say you think a stock is going to go down in value, and the stock is currently trading at $7 a share. So what you do is you short sell it. So let's say I wanted to short sell 1 million shares and the stock is at $7. So I make $7 million. I borrow 1 million shares from a brokerage that holds a pool of other people's shares because you can borrow shares from a brokerage just like you can borrow money from a bank. And so the bank basically takes some of its people's money and gives it to you with the assumption that not everybody's going to ask for their money all at once. So you've made the $7 million by borrowing the shares and selling them. And as a part of doing that, as a part of your contract, you're forced to then buy those shares back at a later date. Let's say the stock price goes down to $3 a share. You owe them 1 million shares, and then you end up buying 1 million shares at $3 a share, and you spend $3 million. You have made $4 million, and the brokerage earns interest on loaning you that money. Now, short selling is kind of a self-fulfilling prophecy, especially in really large numbers, because you're borrowing the shares to sell them, which increases the sell volume, the sell to buy ratio, and that lowers the price, right? So basically, large amounts of short selling can spike a company's price into the ground. So what happens if the price goes up? You short sold at $7 a share and you did 1 million shares, and then it goes up to $20 a share. Well, then you're on the hook for the difference, right? Which would be $13 million. Got to do quick math in my head. But what happens if that keeps going up, right? So a part of short selling is that you have margin, which is basically money that the brokerage is lending you based upon the value of your assets. And as your margin gets sort of eaten up and eaten up and eaten up as your short selling price sort of skyrockets, eventually it's like goes to $50 and then you're really deep in the hole. Your broker can call you up and be like, look, you have to close this position right now, right? Or you have to deposit a whole bunch of cash in order to make it so that you have the proper amount of assets to cover the issue. Well, you don't have that cash, and then the brokerage buys the stock at market value on your behalf. You lose a lot of money, and because they bought, the stock price goes up. So what happened with GameStop is kind of a special case because the short percentage was allowed to become greater than 100%. Meaning that there were more shares that were being shorted than shares even existed in the first place. So once this information became known, it's publicly available information. It was then distributed on the, mostly Wall Street Bets subreddit. At least that's where the focus of the attention has been. And that's a forum on a website. And they all just said, we're just going to buy all the shares at GameStop and we're going to hold on to them. So, they started buying a bunch of shares in GameStop. The price started going up. And then as the price separated from the short sellers, then they had to start closing their position, which caused the price to go up, which caused them to close their position, which caused the price to go up. But there's a case where there's so many shares being shorted that you could ask for gargantuan amounts of money for the shares because there are more people that have to buy the shares versus the shares that actually exist. So GameStop has been the focus of this, but this has spilled over into lots of other companies like BlackBerry and AMC. But despite all this madness and the price going up and short sellers getting blown out and hedge funds going bankrupt, people are still short selling the stock. And there's all the talk of hedge funds bailing each other out, which sort of raises the intensity of the conspiracy and gets people angrier that sort of big money is collaborating in order to crush the little guy. Because if they short sell this right, and whoever blinks first, so to speak, the short seller who guesses the right number, right? If you short sell when the share is $450 a share, and you short sell 1 million shares or however many, you'd make, and then it goes down to $4 a share, you would make that difference, right? Which would be absolutely enormous. And the overall short percentage has decreased over the past couple of weeks, but it's like, short sellers are getting blown out and then new short sellers are replacing them, or some short sellers haven't gotten blown out yet. It's a giant mess. So let's zoom in on some crazy stuff that happened this week. So big money is crying market manipulation. Little money is crying market manipulation. Robinhood and TD Ameritrade restricted the ability to make transactions on the market related to GME and other stocks in the short squeeze frenzy. Robinhood had perhaps the most restrictive deal and attracted the most ire. They just straight up said on Thursday, you can't buy GME, AMC, and a couple of other stocks on their platform, but you can sell though. This made people really pissed off because Robinhood is a tool that retail investors use and the major tool in order to do their investments. And they couldn't participate in the squeeze anymore where they could make or lose a whole bunch of money. With people not able to buy the stocks, the price went down for a while, and accusations of market manipulation and bowing to big money are getting thrown around all over the place. Robinhood has since walked back their restrictions and have allowed people to purchase small numbers of shares. It's gotten so crazy that AOC and Ted Cruz, two people that couldn't be on more opposite ends of the spectrum, have agreed that Robinhood overstepped their bounds. So Melvin Capital was one of the big hedge funds that Wall Street Bets used to rally their community, and they reportedly have closed out their positions at a big loss. And Citron was another name that Wall Street Bets used to sort of gather the troops, so to speak. And they've also reportedly closed their positions at a loss. So if you like the content, be sure to like, comment, and subscribe. We talk to market commentators during the week and we put out interview videos. And so if that sounds good to you, like, comment, subscribe, and I'll see you again soon.